The move started before the headlines. The volume appeared before the explanation, and the chart reacted before the market understood why. I remember staring at the XRP chart that evening, trying to figure out what I was looking at. At first glance, it didn't seem dramatic, just another slow movement in a market that had spent months drifting sideways. But something felt different. The candles were climbing, not violently, but deliberately, one after another. A steady sequence of green bars pressing against resistance levels that had rejected XRP for months. Normally, that kind of resistance attracts sellers. Traders take profits. Short sellers step in. The market hesitates. But that night, the sell orders weren't behaving the way they usually do. Large blocks of liquidity that had been sitting above the price suddenly disappeared. Buy orders started filling faster. The order books looked thinner. That's when the volume arrived. Not retail-driven hype volume, the kind that explodes during social media frenzies. This was quieter, more controlled, the kind of activity that often appears when larger players are building positions carefully. I remember refreshing the exchange data over and over, wondering if it was just a temporary surge, but the buying didn't stop. Meanwhile, most retail traders seemed distracted. Bitcoin was dominating headlines again. Financial media was focused on macroeconomics, interest rates, and stock market volatility. XRP wasn't supposed to be the story, but the chart was telling a different narrative. Because while the market was still debating whether XRP had a future, certain wallets were quietly accumulating millions of tokens. And they weren't just buying. Some investors were doing something much more extreme. They were selling other assets entirely. Bitcoin positions closed, Ethereum portfolios reduced, capital moving out of diversified crypto holdings and into XRP. That kind of conviction rarely appears without a reason, which raised an uncomfortable question. What did they see coming? Because by the time the broader market noticed the price movement, the accumulation phase had already been underway for days, maybe longer. And when I finally started tracing the on-chain flows behind those purchases, a far more interesting pattern began to appear. Someone, or several large players, had been preparing for this shift long before the market realized it was happening, and the deeper I looked, the more it felt like the breakout wasn't random, it was anticipated. The real mystery wasn't why XRP moved, the real mystery was this: who sold everything for XRP before the market shift? And what did they know that the rest of us didn't? Every major market shift begins quietly, long before the headlines, long before the explanations. For XRP, the first signal appeared in the chart structure itself. For months, the asset had been trapped in a narrow range. Every attempt to rally had been pushed back by heavy resistance. Analysts had begun describing the market as stagnant, stuck between regulatory uncertainty and fading retail enthusiasm. But then the pattern began to change. At first, it was subtle, a slightly higher low, then another. Then a gradual tightening of the price range. Experienced traders know this formation well. It often signals something important happening beneath the surface. Accumulation, not loud buying, not aggressive speculation, quiet positioning. The type of positioning that happens when larger market participants believe the risk-to-reward equation has shifted. But the real moment the chart changed came when XRP approached a key resistance level, a price point that had rejected rallies multiple times over the previous year. Normally, traders expect heavy selling at these levels. Instead, something unusual happened. The sell orders began disappearing. Liquidity that had once formed a strong wall above the market simply vanished. As the price pushed upward, buyers absorbed what little supply remained, and suddenly, the resistance level that had controlled the market for months was gone. The breakout wasn't explosive. It was controlled, methodical, and that's what made it so interesting. Because chaotic breakouts often come from retail speculation, but controlled breakouts usually come from something else entirely. Preparation. Charts tell part of the story, wallets tell the rest. When XRP began climbing, I started looking at the on-chain data to see whether the move was supported by real accumulation or just temporary speculation. What appeared there was far more interesting than the price action itself. Several large wallets had been increasing their XRP holdings steadily over the previous week, not in massive single purchases that would attract attention, but through a series of carefully spaced transactions: 10 million XRP, 15 million, 20 million more, each transfer occurring during relatively quiet market periods, late night trading hours, low volatility windows, times when most retail investors weren't paying attention. This pattern matters. Institutional traders rarely buy aggressively unless they want to move the market quickly. More often, they prefer to accumulate gradually, absorbing available liquidity without pushing prices dramatically higher, and that's exactly what these wallets were doing. But what made the activity even more unusual was the source of the funds. Several of these wallets had recently received large transfers from exchanges. In other words, someone had been converting liquid assets into XRP, then moving those tokens off exchange into long-term holding wallets. That kind of behavior usually signals one thing: conviction, not speculation, positioning, and whoever was building those positions appeared to be doing it before the market realized the shift had begun. When XRP finally broke higher, retail traders didn't celebrate. They hesitated. Years of uncertainty had conditioned the market to expect disappointment. Regulatory battles, delayed partnerships, and stalled price movements had left many investors skeptical of every rally. So, when the breakout began, disbelief dominated the conversation. Another fake pump. Whales manipulating the market. This will reverse tomorrow. But markets often move strongest when participants doubt the move, because skepticism delays buying, and delayed buying creates fuel for the next leg higher. As XRP pushed further upward, short sellers began entering the market. Many believed the rally would collapse quickly, just as previous rallies had, but the collapse never came. Instead, the market stabilized, higher lows formed, volume remained steady, and suddenly those short positions began closing. Liquidations followed, the rally accelerated. Ironically, the very traders betting against the breakout became part of the momentum driving it forward. For years, the biggest shadow over XRP had been regulation, specifically the legal battle between Ripple and the U.S. Securities and Exchange Commission. That case had defined the narrative. Every price movement seemed tied to speculation about the lawsuit's outcome, which made what happened next particularly interesting. During the breakout period, many analysts expected the SEC to respond to market developments, perhaps with a statement, an update, or renewed enforcement pressure. But none of that happened. Instead, there was silence. And in financial markets, silence from regulators can sometimes be as important as action. Because when regulatory pressure decreases, even temporarily, institutions begin reconsidering assets they previously avoided. And XRP had long been one of those assets. If the regulatory environment was changing, institutional strategies might be changing as well. Large financial institutions don't chase headlines. They position themselves before the headlines appear. As XRP's rally stabilized, several market indicators began suggesting institutional interest was increasing. Liquidity providers expanded trading activity, derivatives markets saw rising open interest, and volatility began compressing rather than exploding. This is a classic sign of institutional entry. Retail-driven rallies tend to be chaotic. Institutional-driven rallies tend to become controlled, less emotional, more strategic, and the XRP market was beginning to look exactly like that. Volume doesn't just measure activity, it reveals intent. And when analysts examined XRP's trading volume more closely, a surprising detail appeared. Much of the buying had occurred during periods when retail traders were least active: late-night U.S. trading hours, early Asian sessions, periods when liquidity is thinner and institutional traders can move more quietly. This timing pattern appears frequently when larger players are building positions without attracting attention. And in the XRP market, that pattern had become increasingly visible. The signal had been there. Most people simply weren't looking. Financial narratives are powerful. They shape how investors interpret every price movement. For years, the narrative around XRP had been uncertainty, regulatory risk, legal battles, limited institutional interest. But narratives change quickly when price action contradicts them. As XRP continued holding higher levels, analysts began revisiting their assumptions. Market commentators who once dismissed the asset started asking new questions, and investors who had ignored XRP suddenly began researching it again. The narrative was flipping, but not because something dramatic had just happened, because something dramatic had been happening quietly for weeks. Financial markets rarely reward those who arrive late to the story. They reward those who notice the signals early. The XRP shift wasn't just about price movement, it was about timing. Some investors waited for headlines, others watched the chart, some reacted to social media, others followed the wallets, and somewhere during that quiet accumulation phase, a small group of investors made a decision that seemed extreme at the time. They sold other assets, moved capital, and placed a concentrated bet on XRP before the market noticed the shift. Maybe they were right, maybe they were simply early. But their behavior highlights a lesson that appears in nearly every financial cycle. The most important market signals rarely come from headlines. They come from the subtle changes in behavior that happen before the headlines are written, and the investors who recognize those signals first are usually the ones who shape what the market does next.